Okay guys, so welcome back to our channel EduPendent Training. Today discussion will be good corporate governance, but don't forget to subscribe, like and comment before we are going furthermore discuss regarding auditors and audit. Yeah. So we are going to start this discussion with the definition of auditing. Auditing is defined as an assurance service that objectively gathers evidence and communicates into third parties. Companies that are required to prepare financial statements for a financial year must have their financial report audited and obtain an auditor's report. Usually they put an opinion inside of auditor's report. Thus, all large proprietary companies and public companies must appoint an auditors. Usually in our best practice, in the end of financial year, it means before December, September or October, they are already we call it procurement regarding the appoint of public accounting firms. So when they are entrance the company in the end of December, we are hoping that by the end of February or March, the audit report, also the opinion will be finished. After that, we are going to general or annual shareholders meetings in the end of April or May. That will be the definitions and then the timeline when the auditors already appointed by the corporate. So start from September or so that will be the timeline for the company. Usually in the large firm, they can start by the September or October and then up to February or March. That will be the definition of auditing. The link between the auditor and good corporate governance. The first one, auditors do not prepare company report. We should remind that will be the management responsibility to prepare the financial statement. Auditor's role is one of checking or verifying accordance to the financial standards. So when we are discussing auditor, it means we are tend to auditor external. We are not discussing auditor internal because auditor is internal usually under the board of director or executive director in the context of one-tier board mechanisms. Yeah. Number two, how can we link between audited role and good corporate governance? Auditors play a significant role in corporate governance. This is not surprising given the emphasis placed on integrity and on the need for financial reporting that is honest and that presents a balanced picture of the state of company affairs. That will be number two. And then the last one, how can we link between audit role and good corporate governance? The audit provides an external and objective check on the way in which the financial statement have been prepared and presented. So check and balance function came from auditor independence or auditor external, and it is essential part of the check and balance required. The question is not whether there should be an audit, but how to ensure its objectivity and effective. So the 3 points of link between audit role and good corporate governance. Next will be auditor independence. This is very significant, important role. Auditor independence is a critical element going to the credibility and reliability of an auditor's report. Audited financial statement play a key role of promoting the efficiency capital market, and independent auditor constitute the principal external check on the integrity of financial statement. So, if you notice, this is quite important that auditor independence will link into the efficient market. It means efficient market when auditors they are doing their duty with the credibility and also put the value of integrity, it will ensure the efficiency in the capital market. So when we are talking about efficiency capital market, don't forget efficient market hypothesis theory. When there's an additional information, it should be effectively captured by the investor or the shareholders. Yeah. So there will be no additional timing. So the more effective market, it will have a sufficient result, especially in the yield of stock. So that will be related to the efficient market hypothesis. Auditor independence, they have 4 functions. The first one, adding value to the financial statement. Number 2, adding value to the capital market by enhancing the credibility of financial statement, for sure. Number 3 will be enhancing the effectiveness of the capital market in allocating valuable resources by improving the decisions of user financial statement. Yeah, when we can rely the number of financial statement, then we are hoping that we can make a right decisions. Yeah, assessing to the lower of cost capital to those using audited financial statement by reducing information risk. Lower cost of capital. Why? When we can rely on the financial statement, the number on the financial statement, it means they are fairly stated. We can objectively rely on the financial statement. When we can rely on the financial statement, it means the risk will be lower. When the risk will be lower, it means we can assign a lower interest. Yeah, so in the end, cost of capital will be lower. Yeah, so the cost of capital will be lower depend on risk. The higher the risk, we can usually we put a more higher interest. When the higher interest, it means the higher of cost of capital. Yeah, so this will be the connection actually with the risk and then the interest in the end of cost of capital. Yeah, that will be the fourth function of auditor independence. Disclosure of non-audit services. Yeah, two threats of audit independence. The first one is self-review threat. This situation arises when the auditor may need to review work performed either by the auditors or the auditors firms. Yeah. Number 2 actually will be if they are dealing with the others or they are prefer doing consultations, because sometimes consultation is more lower risk, but they can also enjoying revenue when they are giving consultations. Yeah, so disclosure of non-audit services quite important, because we cannot put one will be consultation and then also reviewing of financial statement. That will be conflict of interest. We are going to separate between consultations and then reviewing of financial statement, unless we have assigned two public accounting firm, two different public accounting firm to do the consultation and then to do the reviewing of financial statement. Yeah, that will be the importance of disclosed non-audit services. Yeah. Auditors liability. Liability can arise in three main ways. The first one, the auditors engage to perform an audit pursuant to a contract, usually written contract, or we call it engagement letter in the early stage of procurement. Yeah. Number 2, the law of negligence provides that the auditor will be liable to party to whom they owe a duty of care if they do not complete the audit to the standard required of professional auditor, and the other party will suffer loss as a result of negligence audit. Yeah. Number 3, auditors can be held liable for breach of statutory duty. Number 2 and number 3 will be related to the code of conduct of as an auditor. Yeah, auditor should comply with the code of conduct with the framework their duties according to the auditor's code of conduct. Yeah. Audit committee. Yeah. What is the goal of audit committee? An effective audit committee, usually a committee is under board of directors. Why under board of directors? Don't forget that this context will be one-tier board systems. Board committee is usually under non-executive directors. Yeah, can play a critical role in the financial reporting by overseeing and monitoring the management and the auditor participation in the financial reporting process. They can increase the credibility of financial reporting process by monitoring the opportunistic selection of financial accounting policy. Yeah, so audit committee usually under the non-executive director, and then under executive director they have internal audit. So up to this session, we are knowing three terms of audit: internal audit under executive director, audit committee under non-executive director, and then the term of audit external. This is the independent parties. Yeah. So when the audit committee is to ensure we are not accusing actually. Might be there is an opportunistic selection of financial accounting policy that will lead to the wrong information. So the audit committee, they are playing important roles to make sure that the management is always compliant to the accounting standard and there is no opportunistic decisions. Yeah. Audit committee also have meeting regularly with internal and external auditors, at least occasionally in the absence of management. Yeah. That will be the significant role of audit committee. So what is actually the lesson from this chapter? The first one, auditor and audit are nowadays pivotal to the corporate governance, but that their threshold of why is expected of auditors and audit have been raised considerably in recent times. Number two, the lessons will be expectations that auditors should be independent, that they should report breaches of the law. If there's any violation, if there's any violation to the contract, violation to the accounting standard, then the auditor should make a report. Number three, the lesson will be ensure that the financial statement better reflect the true financial position of corporations. This will enable investors to make sound investment decisions based on the financial statement reflecting the true financial position of corporations. So that will be we have 1, 2, 3 lessons from these chapters. And also, I'm hoping after these sessions, this will be the trigger, you can more elaborate how we can link between the audit and also the auditors to the implementation of good corporate governance. Okay, so that will be wrap up for these discussions. And then don't forget, stay on independent training.